Investors are caught in a whirlwind of hope and anxiety as they eagerly anticipate the possibility of interest rate cuts. Wall Street has been reveling in this expectation, with the S&P 500 experiencing a 15% surge since late October. The trigger for this optimism has been the moderation of the annual increase in the Consumer Price Index, easing from its 2022 peak of over 9%. However, the reality is harsh contrary to expectations. The Federal Reserve is unlikely to cut rates as promptly as the market desires. This sobering truth casts a shadow on the jubilation, raising concerns about the resilience of the economy and the impending impact on stock markets. Is this party on Wall Street premature? And are we underestimating the economic challenges that lie ahead? Welcome to Global Economic Drops, where we bring you simple summaries of important daily and weekly economic news from around the world. Our mission is to simplify the economy and help you navigate the treacherous waters facing investors today. So, before we get into today's videos, hit that subscribe button and turn on post notifications by clicking the bell icon. And if you find our news briefs valuable, don't forget to hit the like button. Leave a comment down below telling us just what you think is going on with the state of the world, and share this video with a friend or two so that you can all stay updated together. Thanks for watching, and now let's dive into it. The misaligned expectations. The illusion of imminent rate cuts. Despite the fervent hopes of a rate cut, the Federal Reserve seems poised to play a waiting game. The rate cut optimism stems from a belief that it's the antidote to the 11 interest rate hikes since March 2022, aiming to prevent an unwelcome recession. However, the current economic and inflationary landscape doesn't align with the expectations of swift rate cuts. Inflation continues to surpass the Fed's 2% target, with the Consumer Price Index persistently in the three-handle territory. The market's anticipation of a March cut, evidenced by a 61% probability, according to the CME FedWatch tool, might be overly optimistic. Inflation dilemma and the fragility of consumer demand. While inflation has somewhat receded, a premature easing of policies might reignite it. The two-year Treasury yield, a measure of short-term rates, has decreased, but there's a looming risk that it might encourage more consumer spending, counterintuitive to the Fed's aim of curbing inflation. Consumer companies aren't rushing to increase inventories, indicating a cautious stance in the face of uncertain economic conditions. The delicate balance between managing inflation and supporting economic growth places the Fed in a challenging position. The economic reality check. The timeline for rate cuts. Analysts, such as Steve Englander of Standard Chartered, contend that the incoming macroeconomic data does not support an immediate rate cut in March. The expectations might be more realistic looking towards mid-year 2024, forcing investors to confront a delayed gratification scenario. If these predictions hold true, the market could witness a backlash as short-term rates rise, impacting demand and subsequently corporate profits. The disconnect between market exuberance and economic reality presents a stark reminder that patience may be the most prudent strategy. Are investors prepared for a reality check, and can markets weather the storm of delayed rate cuts? Conclusion. In conclusion, the fervor around potential rate cuts appears to be based on optimistic projections rather than current economic realities. Investors might need to recalibrate their expectations and brace for a more extended timeline. The delicate dance between managing inflation and supporting economic growth requires a measured approach, and premature actions could have unintended consequences. As we navigate this economic landscape, the question remains, can the markets sustain their exuberance in the face of a delayed and possibly more nuanced approach by the Federal Reserve? Share your thoughts in the comments section below, and remember to subscribe to the channel to stay up to date on global economic news. See you on the next video, and please like and share if you enjoy our content.